Driveline Automotive Advisors is our featured supplier guest today, and the topic is, you see on the PowerPoint, is unlocking profits in insurance and warranty products. And we'll have Chuck Pappas, our VP of Operations, come on in just a moment to introduce our guest presenters. So let's get things rolling now with Chuck. Chuck, the floor is yours.
Thank you, David. Welcome, everyone. Thank you for registering for our Profit Improvement webinar. We're glad you're joining us today. This afternoon, we're pleased to present Scott Noggle and Brian Marshall from Driveline Automotive. Today, Scott and Brian will unlock profits in insurance and warranty products. We'll bring Scott and Brian on in just a minute, but we have a slide up right now. So if you're interested in a copy of this deck, just scan the QR code and we'll make sure that we get a copy of this sent off to you right away. It may take a day or two, but you'll get it if you scan this in. After you review it again, I'm sure that Scott and Brian will be able to answer some more questions that you may have. You know, we started this webinar series about 3 years ago. And in the course of these webinars, we presented a wide variety of category topics: audit recovery, reducing shipping costs, market analysis to our buyers, dealer DMS, aircraft financing, shop supplies, hidden opportunities in your service department, and our popular buy-sell webinars, as well as revenue-producing opportunities, all intended to reduce expenses and improve profitability. If you're new to this series, we encourage you to stay tuned and watch for other profit improvement topics that are coming up. With that, I'll turn it over to Scott and Brian. Scott, Brian, take it away.
Thank you, Chuck. Thank you, as always, StrategicSource, for giving us the opportunity to present. This is our second webinar for Brian and I at Driveline. A few months ago, we did a webinar on debt opportunities and treasury management opportunities, which we had a lot of fun doing, and I think it benefited a lot of people. So, and that's the whole point of these webinars, helping our dealership brethren, and it works. So we're very pleased about that. Today's webinar is, as you can see on the screen, unlocking profits in insurance and warranty products. Brian and I like to say this is the I in F&I, is where we're going to focus on today. I'd like to nice shout out and kudos to Forbes. Forbes did a presentation about 3 or 4 weeks ago, I believe, on reinsurance. I thought it was great. It was very informative, very technical, and I'd like to think that Brian and I are going to probably supplement some of the understanding there. But I think also we're going to try to do a kind of a perspective of what a CFO or an owner or another key person would be at a dealership in evaluating these products, but also what structures. These structures come in a lot of shapes and forms, and we'll get into that in subsequent slides. But I would encourage all attendees, if you haven't already, to review and understand and appreciate Forbes' wonderful presentation that they did a few weeks ago. I thought it was excellent. So we'll go to the next slide. So right here we have a lot of material to cover. A lot of this might be known to a lot of people, so we apologize for that. I know in subsequent or previous sessions, so this might be new to people, reinsurance and what we call profit share opportunities. So we hope that patience resides and people have seen this before, and I hope this is a great opportunity for all to learn something from their webinar. So let's start right from the top. Overview of products sold. Brian's going to discuss this in a little bit more detail later, but we have a slide where there's 12 items sold by the F&I department in insurance and warranty. I would say not all of them have a home in a reinsurance or profit share structure, but nevertheless, we'll go over them briefly. Overview of structures and expenses. As said before, these profit share and reinsurance structures, you probably heard of them. They could be retro, they could be a CFC, an NCFC, or a dealer-owned warranty company. When I started in automotive retail about 30 years ago, I didn't know what any of that stuff was, but it's really evolved and it's changed a lot since my first day in automotive in 1994. So, but we'll go over a little bit about that. Importance of technology and training. I know I've been evaluating these programs for almost 30 years, and it's funny how technology wasn't emphasized 30 years ago. but it certainly is now with the advent of technology and phone apps and all that. But I would say that technology can drive business. And let's cut to the chase. The most effective thing for any program is to drive sales. So to the extent that we can leverage off technology to do such, it can only be a good thing. Training. Again, doing this for 30 years and evaluating these programs for 30 years, I've seen a lot of difference between different providers and agencies in the, I would say, the attention to training, the quality of training. But I cannot tell you how I've seen focused training lead to higher penetrations of F&I product. I mean, I've seen some agencies and providers almost live in dealerships to get those numbers up. So something that I want to make sure everybody understands is very important. Importance of claims management. I'm a former CFO in automotive, and I remember I spent a lot of time looking at claims in the property and casualty arena, and workers' comp for that matter. And I did notice one thing. If I didn't spend a lot of time on claims management, the claims would get a little bit out of control in frequency and severity. This is no different. You got to understand your claims. You got to understand the frequency. You got to understand the severity. But what you want to make sure is that you don't want a lot of these claims leaking to your competitors' parts and service departments, because you're going to lose a little bit control, and your claims are probably, ratios are probably going to go up unless you retain them and bring them back to your own store. So something to keep an eye on and emphasize. And importance of investment income. Again, we're going to go over a few structures here today. And these opportunities in investment income will vary. I know in my world, in my 30 years in automotive, I'm finding that DOWC seems to provide the best investment income opportunities, followed by CFCs, NCFCs, and finally retros. Retro, I would say, is materially different than what we could, on a long-term basis, what we could squeeze out of the other programs. So I think this brings us to our first poll. So let's go here. Get it here. Here we go. So getting to know our audience today, it's always good to get to know who our audience is. So please respond. A lot of times your responses may steer our presentation a little bit, so we know who we're talking to. All right, so we have a pretty good cross mix. We'll make this more of a less a general. We'll make it more of a general presentation, not steering any specific way. So we'll get started, and we'll end this poll, and we will move to our next slide. Okay, so let me tell you a little bit about myself, and I'll turn it over to Brian. So I'm in my 30th year in automotive retail. Brian and I co-founded Driveline Automotive Advisors with the express purpose of helping out dealerships. We found that a lot of dealerships have controllers, brake controllers, office managers, but maybe because of budgets or priorities, they don't have a full-time CFO. So we fill that niche. I've been fortunate enough to work for 3 large groups in senior financial positions. I worked for Home and Automotive for about 20 years. I moved over to DCH ahead of the sale to Lithia. And Capstone is where I met Brian a while back. And at Capstone, we had rolled up on over 60 dealerships, and that was a PE-backed endeavor. A lot of that dealership group was ultimately sold.
Recording stopped.
One. So what do we do at Driveline? Again, we're basically a fractional CFO firm. We aid in anything financial and accounting-wise, but more specifically, yes, we do buy-sells. We do debt sourcing, refinancing. We do risk management. You guessed it. We do reinsurance and profit share, and a whole host of anything in the financial and accounting arena. So I'll turn it over to Brian. Brian, if you'd like to introduce yourself.
Sure. Thanks, Scott. And thanks, StrategicSource, for having us here today. So my name is Brian Marshall. Kind of a similar background to Scott, but I had some detours along the way up front. So I've been in automotive for about 15 years versus Scott's 30. In that time, I've been anywhere from in a public accounting firm, servicing dealership clients, to in the PE-backed roll-up that Scott was mentioning, and working in the corporate finance and accounting office at dealership groups, until The underlying groups under like Prime Automotive was sold to Group 1. After that, I've been out on my own doing a lot of this consulting with Scott, for instance, on cost reduction, debt refinancing, like he mentioned, an overall, broad look at anything below the gross profit line where we can help a dealership group make more profit or increase their cash flow. And that is why we're here today. So we can go to the next slide.
Yep. There you go, Brian.
All right. So just a little bit, what are the business problems that we solve? And this is, particularly in this F&I area here. So one is that a lot of people, if they've been with, or dealerships, if they've been with their F&I provider for a long time, and we have a polling question on that later in the presentation, a lot of them are just unaware of what the different structures are. They've always been a certain way. It's been that way for years. And they can be unaware of different structures that are out there that have different risk profiles and different benefits. Similarly, they can be unaware of what the market pricing is. The reps are always there to be your friend. They're customer relationship professionals, and the dealerships will have great relationships with them. But you might not be aware that outside of that relationship, the market pricing has changed over time. Maybe your dealership group got bigger. Maybe the overall market became more competitive, and you might be paying more than you should be if you were routinely putting your F&I, a business out to bid. So that's, again, where we come in. We are aware of the market pricing. We're doing this for lots of dealerships across the country. So we have at any given time, we have a pretty good sense of what the market pricing is for various expenses that are involved here. Next is just we solve the problem of the lack of time and resources. From having been in a dealership group, I know the accounting staff and the executives always incredibly busy. About half the month is spent with wrapping up the prior month, getting the dealer financials out. And it just leaves very little time to engage in long-term, strategic type actions. So that's where we come in. We're not involved in closing your books. You're handling that. We can do these longer-term, complicated strategic projects, such as doing a competitive analysis of your F&I program. And last is the shallow connections in the market. Just kind of going back to what I said before. Scott and I are doing this all the time. We have contacts with many different F&I providers. In a typical dealership, especially if you've been with one for a long time, you might be very familiar with that company, but not have the connections at the other, 10 or 15 companies, the major companies that are out there. So that's where we come in. We can use our connections, our time, our experience, our awareness of market pricing to help you generate a better situation for your company.
This is a pretty busy slide, and it's a little small, so just bear with us as we kind of zoom in and zoom out on it. So I'm going to rely on my technical help to do a little zoom on it. So while that's being done, let me explain what we're seeing here, and then we'll start on the left-hand side of the presentation as much as possible. There we go. Okay. So if we go a little further, that's perfect. Right there. Perfect. So what I'm doing here is you'll see a black bar, and it's separating two columns. So where it says at dealership, that's typically what a dealership is making on the sale of we'll say a service contract, right? This is not intended to be representative of all F&I products, but let's assume this is a proxy for service contracts. In the old days when I started, there was no right-hand column at all, right? And then you'll see what a revelation this was about 30 years ago. So what we have there on the left-hand side, again, is how the dealership used to make money until someone unlocked this idea of reinsurance and profit shares. So $3,000 paid by the customer, $1,500 gross profit to the F&I department, $1,500 would then be remitted to the reinsurance company or the insurance provider. That's the $1,500 carries over to the $1,500 to the right of the black bar. Now, at this point, when you have a reinsurance company, a DOWC, you have to pay admin fees. Someone has to administer the claims. Someone has to do training. Someone has to invest in the technology. Typically, that comes out of the admin fee. I know a lot of people say, give me the lowest admin fee. That sounds good on paper, but if it's costing you technology and training, that's not necessarily the best thing to do. So in a reinsurance, more often than not, you're going to have to pay some state taxes, some seeding fee or seeding taxes. In this case, we assumed 1.5%. Not a surprise. The biggest expense in the reinsurance company is the claims. We assume 50%, 50% of the $1,500 is $750. Now, here's what's nice about these programs. You're cutting checks on day one, the $1,500. On day one, it starts earning interest income, okay, or investment income, okay? Now, the way this thing works is claims come in over time. You know, they don't come in all on day one. If you have a 5-year contract, you're going to earn investment income in some way, shape, or form for 5 years. Your claims are going to come in on a new contract. You may not have no claims because the bumper-to-bumper warranty is in there. But what I want to emphasize here is that investment income is a nice big piece of the total profit of a reinsurance company. Now, again, when we go to one of my earlier slides, there are some other structures that are better than others, in my opinion, where you can get better investment yields. I know in retros, which may not be the most which some dealerships are still using, I would say that they provide the lowest yield. Something to look at if you're in a retro. So importance of investment income. So our subtotal there is we have $740 in profit before tax. In a reinsurance company, investment income only is taxed. All right, we assume the 35% tax rate or $39.38. Okay, there's different taxations depending on the other structures, DOWC and retro, but we're just going to, just for this illustrative, just assume this is the CFC. So reinsurance profit after tax is $700. Let's stop there for 1 second. In the old days, 30 years ago, at least in my world, the dealership never saw that, okay? Now he is seeing it. So this was a big revelation, a lot of money for a lot of dealers to get that money. I know when I was listening into the Forvis presentation from a few weeks ago, it was revealed to me that some dealerships aren't even in a profit share arrangement. So I would strongly urge those participants, if you're on the call today, that you start investigating that. So, all right, so let's look at this. So you see that $763, as you see it repeated 4 times, right? Some dealerships, one of my former employers, actually would give the money back to the dealership, right? The idea was the dealership produced the contract in the first place. Let's let all the managers, controllers, everybody else that appreciates the profitability of the company to enjoy some of that money, right? Some dealerships to the right hand of the bar, and you'll see there's that $763 or 63 cents repeated twice. Sometimes the owner keeps it. Sometimes it's shared by key personnel at the dealership. Some people put it into a family trust, an estate planning vehicle. So there's a lot of wealth management opportunity there. So just making sure that you can put them in different buckets, those profits in a reinsurance company. Okay, and then on the left-hand side of the bar, black bar again, you're going to see just to the left, if you could, where you were, and then up a little bit. I'm sorry, down a little bit. Down. Sorry, down. Sorry, trying to get to the bottom of the spreadsheet. All right, so there you go. So if you combine the $1,500 on the front end to the $700, that's $2,200 for this one contract, right? That was sold, this service contract, and with all the assumptions. Now, you're going to see a number there at 75%. That 75% on the left-hand side of the black bar is $763 times 75%, you're $525. Some dealerships have arranged with their providers to get all their money up front at a discount. If you were to take that $763, if it's a 5-year contract, it would take you 5 years to get that $700. So some dealers say, you know what? I don't want to wait that long. I'll take the discount of 25%. Give me all the money now, right? So I've seen those arrangements quite frequently, actually. So, okay, now if we can go all the way to the right of the spreadsheet, under dealer valuation power, there you go. All right, so that you'll see that 500. This is repeating itself, but that you'll see that $500 again at the top of the column all the way to the right. There you go. Now, what I'm trying to emphasize here, this is a cash flow, play. We get it. You saw the amount, all right? But if you're a seller and you're selling your dealership, okay, let's assume that you made $525 on all these contracts, right? Every one you sold, okay? Let's assume your annual sales is $2,000, 45% penetration rate on service contracts. That's 900 contracts a year. If you're making $525 on each one, that's another $472,000 that might be off the financials of the dealership. Now, here's the deal. If you're in a buy-sell and you're trying to sell, obviously you're trying to up your price, you definitely need to let the buyer know that this is the cash flow that stems from the dealership. I assume the 5 multiple, it's debatable what it's worth, but I just said let's just take a 5 because a lot of dealerships are selling at a 5 multiple. The 5 multiple times the that I think it was, what was it? No, we'll get back there in a second. There we go. Yeah. So if we take, we got off it again. Yeah. So we take the 400 and some $1,000 and we multiply it by 5, 470 times 5. The valuation of the dealership theoretically should be another $2.3 million by dragging in this cash flow that's occurring off the balance sheet and off the income statement of the dealership. So I know I gave you a lot of information. I'll walk through this painstakingly with anybody who wants to contact Brian or I to go through that math. But I just wanted to show you the power of reinsurance and the power that it can add in cash flow and the power in the valuation of the company. So we'll move from that slide. I believe we have a polling question coming up. There we go. All right, so we do have a polling question. So let's poll our audience and see what is the most important criteria when they're selecting their F&I provider. Brian and I, when we were drafting up these polling questions, we try to guess what it would be. So this is going to be interesting.
Yeah, I think I do.
Brian. We were not right. We were not right. All right, so the most common answer was variety of product offerings. That makes sense, obviously, I guess. I mean, I think they all make sense, but I can see why there would be an emphasis. So just for the people out there, product offerings was 60% of respondents. Cash flow, profitability, and technology were tied for second and third most common response. All right, so that's interesting because perhaps because the variety of products could actually produce more contracts, which actually can get you right back to your cash flow and the profitability. I am very happy someone said technology. I did not expect someone to say technology, but as I said in my earlier slide, it's something that's underappreciated because I know through my experience and emphasis on technology and the way it can market things and drag customers back into your dealership and also to help you manage the programs is an extremely important element of this. So we'll exit the poll and we will move to our next slide. Let's see. Okay, Brian, I believe this is you. You're going to tell us a little bit about the product offerings.
Yep. So, and this is just for most people that are in dealerships, if you have any connection with this, we're not going to spend a lot of time on this because you're probably familiar, but this is just an overview of some products that can be sold in the F&I department. So ranging from the vehicle service contracts, that was the example that Scott just did, GAP, guaranteed asset protection, which just protects the customer in the case they have a loss on the vehicle that exceeds where the insurance proceeds are less than the outstanding loan amount. Lifetime powertrain warranties, lost key, windshield and glass, prepaid maintenance, tire and wheel. These are all of these different products can be treated in this way with one of these reinsurance structures. And deals will sometimes bundle various products together. So there's numerous examples, and apparently this is something that's very important to all the dealers. I thought it was going to be the cash flow and profitability, but but I was wrong. So not too much more on this slide. If we can go to the next one. Okay, so here we have just a quick overview of some of the different structures that are available. And this kind of ranges from the least risky with probably the lowest return up to the highest risk, and then, of course, the highest reward, actually, as we go from left to right. So retro is the simplest program. There's no risk to the dealer on it. The dealer is not setting up their own insurance or reinsurance company. Their provider is taking care of all that stuff, and the dealer is just getting a check, once a quarter or twice a year, whatever the case may be, however they set that up based on the underwriting profits as they earn out. So you might get nothing, in the initial stages of the program, and then you start getting checks down the line as the different contracts start earning out. So again, no risk to the dealer, but the main flaw here, or the part that makes it maybe less attractive to a lot of the dealers, is all the income that comes in, whether it's coming into the dealership or somewhere else, is going to be taxed at ordinary income rates. So you'll see the other structures as we briefly talk about those have some tax benefits that could make those potentially much more enticing to a dealer. So next is reinsurance or an NCFC or a CFC. So that's just the difference between those two is really on the ownership structure. An NCFC is a non-controlled foreign corporation, and a CFC is a controlled foreign corporation. These are typically structures where, so in this case, the dealer is setting up an actual reinsurance company, and that's usually in an offshore, some sort of offshore jurisdiction, Turks and Caicos, or the Bahamas, somewhere offshore. And so in this case, the dealer actually bears some of the risk of those losses. They can have, if the claims management gets out of control, there's a chance that there are no underwriting profits down the road. But what comes with that, so why would a dealer choose this, is the benefit is they're getting typically a higher rate of investment return. And also there is a shield, and this, I believe, is the only technical tax thing I'll say in this presentation. These companies are set up as 831B captive insurance companies. And what that allows you to do is the underwriting profits from this year, I believe the limit is $2.8 million. So if you have up to $2.8 million in ceded premiums, the underwriting profits from that is excluded from taxable income. So the difference is, on the retro structure, you have no risk, but you're getting taxed at, whatever, 35%, whatever the dealer's marginal tax rate is. On the reinsurance aspect, you have risk, but you're shielding that first, $2.8 million of premiums. The income that's generated from that is being shielded from tax. So that can be an absolutely huge benefit to the dealer. And next is the dealer-owned company, or a dealer-owned warranty company, DOWC. So that is where the dealer or the dealership himself owns an insurance company. That's set up as a domestic C Corp. So you do have some tax issues there. However, in this case, all the underwriting profits are flowing directly to the dealer. And the way that it's set up, from a tax perspective, is the income earns out over time. Like Scott mentioned, if you have a 5-year contract, those profits are coming in over 5 years. But based on the tax code, the dealer is allowed to take a lot of the expenses that go along with, selling the commission back to the dealership's F&I department. A lot of the expenses that go along with it are all recognized up front, and that can give the dealer a massive tax shield for the first several years that each year of these policies is up and running. And Scott, I believe you have a client that had an amazing result with that. If you want to share that.
Yeah, I certainly will. So again, going back to the Forvis presentation, again, I was surprised that there was some dealers that were not in any of these structures, and they were just getting their F&I income, and maybe they could have had an ad hoc program, some loyalty checks would come to them, whatever, right? I know when I started this 30 years ago, we did start with a retro. We wanted to get our toe wet. We wanted to understand it. But then we realized, because of the nature of our company and our tax situation, that, stepping it up into a different structure made sense, right? I do have a client. We literally just switched them over 3 months ago from a CFC to a DOWC. The reason why the DOWC worked for them is it so happened they are a C Corp, meaning the dealerships were a C Corp. And as Brian said, a DOWC, an insurance company, must be a C Corp, so we could consolidate them together, okay? Now here, and Brian also mentioned that there was a tax shield, right, afforded by the DOWC. And in my client's case, in the first year, we're going to be able to shield $17 million in paper losses from the DOWC insurance company against their dealership profits. Just multiply that by a tax rate. You can do a quick math and find out that they're going to probably save $3-4 million in tax payments in year one. That also came along with a change in provider as well. Reverts back to a lot of the other things we were talking about to look for in a provider, whether it's admin fees, technology, training, you name it. It was a nice step up. So I think the takeaway from this is you may be in a structure, you think it's great, but I would strongly recommend just evaluating other alternatives. You never know. You just never know. I will say that if you haven't looked at it in a while, things have changed in the marketplace, and they may have changed in the marketplace for you for the better. So that was my commentary, Brian. Do you want to discuss anything else on this slide?
No, I think that covers everything I had on this slide. We can go to the next,
Okay.
which I think is a polling question.
Yeah.
So after the structure slide, of course, what F&I structure are you currently using? Actually, pretty even
spread out, isn't it?
Yeah.
Well,
all right.
Go ahead, Brian. You can summarize.
Yeah. So basically, relatively even split. There's some nuns. A little bit, about a third is in a DOWC, and then another third is in a retro program. So nobody in a CFC or NCFC. Yeah, so that's good. It's a nice mix. But no matter which one you're in, like Scott said, and I know this concept is near and dear to StrategicSource's heart, is a little bit of friendly competition is always the best way to make sure you're in the best situation for yourself. So, take the opportunity to look at different options, and you might find that there's something out there that's better than the one that you're in now.
Yeah. I just want to add one more thing, because I know there's some dealerships that we said none or a retro. Even if you're a smaller dealership, don't think that you can't use one of these programs. If you're a retro, and you think because I'm small, I don't even want to go to a CFC. That's not true. I mean, I've seen some very small dealerships in a CFC, and again, they're getting tax benefits. There's no question. They're only getting taxed on their investment income. So the people I really want to talk to are the ones that respond to none, because I'd really like to understand that, because maybe there's a situation I'm not thinking about, but it's hard to believe that there's not something there for you. So just want to put that commentary in there. So, all right, we'll end that poll, Brian. We'll go to the next slide. There's a little lag. Here we go, Brian.
And this is basically just a kind of a clean graphical representation of that past slide. So you can just see the CFC, the NCFC, and the dealer-owned, you do have entity formation costs. You will have separate tax returns that need to be done. There's going to be regulatory filings that need to be done, admin fees. But it just, down at the bottom, it kind of summarizes the income benefits there. So retro, again, just talking about it's taxed at ordinary rates. You're getting probably some kind of lower crediting from your provider. Your provider is not giving you in the retro. I don't think I was super clear on this in the original slide. They're not usually giving you the actual investment income. They're saying, okay, we're going to give you, whatever, a 5% interest rate on whatever's in the reserve. Now, they might be making a lot more than that, they're giving you a
Right.
lower rate. Whereas in the other two, the reinsurance, the CFC, and the dealer-owned warranty company, you're actually getting whatever the actual investment income is that you see. And the dealer-owned company, as it says there, has the highest reserve, and at least in the first couple of years, the best tax shield. So I believe the next slide is that one, another polling question.
Yeah.
Going against this one now. When was the last time you switched your F&I provider agency? I don't remember, never, 1 to 5 years, 6 to 10, or why would I even do that?
I remember when Brian and I did our last presentation, it was opportunities in debt, and we asked pretty much the same question, was last time they changed their bank. And I believe the most common question was, I don't remember, right? Or when did they last market it? Okay, and it was
right.
It was a long time, and I think that's the point here too. Is things have changed a lot in this market. Believe me, since I did this 30 years ago, but through my whole career, it's been things change. Let's put it that way. And frankly, when I say it's changed, I think it's changed for the better for the dealer in many cases. So I would encourage, like I do in my CFO world, I tested pricing on all my vendors at the latest every 3 years, some more often depending on the product or service and what have you. So Brian, why don't you summarize our results?
Sure. So it is looking like that these F&I relationships are long term. So we've got basically all the answers are in either never or I don't remember. So again, I would say big opportunities there. The companies specialize in making sure you feel like they are really there looking out for your best interests. And, I'm not meaning to imply that they're bad, but, they're in this to make money as well. And if you check and you put this out through some kind of competitive process, I would say there's a better than even chance that you're going to find out that there's more opportunities, that the relationship has just become comfortable over these, many years. And if you really kind of hold their feet to the fire, it doesn't mean you have to switch. You could just say, hey, we're putting this out to a competitive bid, and maybe your incumbent matches whatever the best other rate is. And then you get the best of both worlds. You have no disruption and you just get more profit. But going through a competitive process, like Scott says, at least every couple of years is really the best practice for maximizing the profit in your dealership. So let's go to the next slide now. Looks like Scott had the front half of the presentation and I have the back half. So
I'll come back. Don't worry.
So this is our process wheel and the problems we solve. And so basically our process, we try to make it as turnkey and as pain-free as possible. So we do a data collection. If you were to use our service to evaluate your F&I options, we collect your current data. So what provider are you with? Samples of the contracts, what's maybe your Stone Eagle reports or something else, so we can see exactly, how many contracts and different types that you're selling. We apply that against our industry database of what's in the market, what different providers and agencies are offering in terms of fees, training, technology, etc. And then we prepare a bid package or a marketing package summarizing the dealership. How many units are you selling? Where are you located? And pitch that out to 5 to 10 companies to see which one is going to give us the best offer. It's a blind process. We're not telling anybody what the current pricing is. So we're trying to get them to all put their best foot forward. And if they want the business, they'll come up with competitive pricing, which really is how you are going to drive the best results for your dealership. So that's step 3 and step 4. And then we come back, so we'll summarize all this stuff in a table and say, okay, here's, providers A through F on all these different features. They offer these different structures. Here's their admin fees. Do they offer training? Maybe you don't want training. Maybe you have your own F&I personnel, that you want to handle training in your dealership. And you say, well, give us a discount on the admin fee because we're never going to use your training service. Whatever is important to you, we're going to present those results to you. Dealer's going to make the decision. based on their personal, tax situation or increased, cash flow, different technology and training, whatever is important to them. You guys are going to make that choice, and then we help with the closing and the implementation. So again, to reiterate from the beginning, the problems we solve, you might have above market admin fees and be unaware. You might be in a structure that's not the most advantageous for you. And there might be different technology and training products available for you that you're unaware of because, as we saw in the poll, you've never switched or can't remember when the last time was. And what benefits do you see from that? Well, basically one for one, if you have above market admin fees, you have the chance to lower those fees, and that translates into more income on the back end. If you're in the wrong structure, a better structure is going to give you generally a better risk profile or a better tax savings profile. And if you're not taking full advantage of the best technology and training that's out there, and you do take better advantage of that, you're going to see increased penetration of products, which is going to have a twofold effect. It's going to increase your profitability on the books of the store, the F&I PVRs, and then it's also going to increase this kind of back end money, the NCFC, CFC, or dealer-owned warranty type profit. And then the different structures could see, even if all the other profits on the face of things are the same, the dealer could personally have better profits after tax based on switching into a more advantageous structure. So then the next couple of slides.
So Brian, what we're going to do is, because we're coming near the core part of our presentation, we're getting near the 45-minute mark. Let's just kind of wrap it up, I guess, summarize.
Yeah, because these next couple slides are really just going back over I really just covered all these slides when we had that last one up, so that's fine.
Yeah. So wrapping this up, we just want to leave some time for questions if there are any questions. I saw a couple came in already. So what is our assessment offer? As what we do at Driveline is we do free assessments, right? We as Brian has his little process wheel, we call it. We just collect data, and then we look at it, we assess it, and we give you feedback. It's free, right? If you choose to move forward and engage us, then you just unleashed us, right? To hopefully do something very good for you. Brian and I won't do that, right, or make that recommendation unless we think it's worth your while and, frankly, our while, right? It's got to make sense for both of us. So what we like about our thing, and a lot of our clients love it about us, is we're transparent. We can be blunt sometimes, but we will tell you if we think there's opportunity. So that's our assessment offer. I guess at this point, we'll see if it's okay with Chuck and our guy behind the scenes, Dave. I think it makes sense to maybe get ahead of some of the questions. We'll wait to see if any more questions come in, but let's just go through some of the frequently asked, maybe head off some questions. So real quick, in what areas do you find opportunities? The answer to that is actually easy everywhere. There's a lot of buckets. There's a lot of areas, what I call a lot of honeypots in the I in F&I, and within these structures, profit share, as I call them, or again, reinsurance, CFCs, DOWCs, and retros. There's a lot of opportunity out there. There could be a silver bullet in there, but usually it's more than one or two or three things where there could be an opportunity for the dealer to enhance those profits in these structures. How much can I increase profits? That's another question we get a lot. I've had one client. It's a small dealership in a rural area where we did an advisement and we got him another $100,000. That was actually a 33% lift though over what he was getting under his older program. So while it might not sound like a lot dollar-wise, percentage-wise, there's no way disguising it. It was a 33% lift for him. I have another client we mentioned earlier that we're going to increase his program benefits and profits by $1 million a year. So it's obviously highly contingent on the size of the company, how much contract penetrations, and what situation they were in before. but it can be extremely material to the bottom line. We already have a great F&I provider. Why do we need Driveline? Brian, why don't you tell us why we're great?
Because we run through a competitive process to check all these different buckets to make sure that your admin fees are correct, that you're in the best and most advantageous structure, and that if your penetration rates are below what we see in the market, that maybe you could take advantage of some better technology and training. And even though you may have a great provider, it doesn't mean that they can't do better. There's always room for improvement, and by doing a competitive process, that's what we help the dealer achieve.
All right, and how long, Brian, will it typically take for our assessment? And then
the assessment is pretty quick, unless if you have a large group where there's like 10 stores and we need to get data from all 10 stores, that can take a little bit longer. If it's just a few dealerships, if we get the information, it should be relatively quick. And the assessment itself usually will take less than a week, a couple of business days.
Yeah. So, okay. Looks like some of our questions were actually included in our FAQs, Brian. So that was a good thing. So
yeah.
I think what we'll do there is I think we're ready to wrap it up. I think we're right on schedule. So I think right now we just, in closing, for Brian and I, you'll see our contact information. Scott Noggle over there on the left. You'll see Brian over there to our right. Take a screenshot or whatever. You always, I'm sure you have access to the presentation later. So in closing, thanks for your time. I know it's all coveted, everyone's time and energies, and hopefully we can help you down the road. So thank you.
Thanks, Scott and Brian. We would encourage you to reach out to Scott and Brian to find out how to unlock profits in insurance and warranty products for your dealership. With that no-cost assessment program that they just offered you, you have nothing to lose except more of your own money. So I'd definitely take advantage of that. The webinar will be up on our website in the next day or two. Just scan that QR code, supply your information, and we'll forward you a copy. Thanks again, Scott and Brian.
Thank you.
For anyone thinking about their expenses right now, the question is, how much money are you leaving on the table? Most dealerships are overspending on supplies and services by 25% each month. There's about 150 expense categories options that are out there for you to spend money on. Most dealers will spend roughly in 100 of those categories. Spend as a percent of sales is about 5%. So if you do 100 million in sales, that 5% equates to $5 million bucks. 25% of that is about $1,250,000 on an annual basis, which you have the ability to save with StrategicSource. 95% of the dealerships in the United States are decentralized, meaning that they do not have a purchasing department, and each location has the freedom to go select their own suppliers and buy. StrategicSource can be the purchasing partner for you that can pull all of that together. A business problem, too many categories. Typically, there's not a plan to effectively attack categories. Dealers are short-staffed. StrategicSource has a lot of experience in cost reduction analysis and analytics. Last year, we completed over 2,300 sourcing projects in expense categories used specifically by car dealers. Expense challenges. Dealers are typically overpaying for supplies by 25%. There's a broad scope of categories. There are way too many suppliers to manage, too many supplier invoices to process, and there are too often few discounts and rebates that get taken care of. So the question and challenge becomes, how do you simplify that? This slide shows what the annual savings opportunity might be for 4 different size revenue groups, ranging from 25 million to 300 million in annual sales revenue, and what that savings can look like on a monthly basis. Remember, the cost savings drop to the bottom line, so it has an immediate impact on your profitability. Just touching briefly on expense category scopes, there are 72 categories regardless of what business you're in. If you're a dealership, a church, manufacturing company, or a service provider, you're likely to spend in these 72 categories. If you own your business or you own your facility, or even if you're leasing it, you're probably spending in these 15 related categories. If you're an automotive dealer, there's another 56 expense categories right here. So you can see how that scope of work can be quite large, up to 130 to 150 categories. That can definitely be a bit overwhelming. Our strategic source solutions. We have a profit improvement program. We manage the process of conducting a financial analysis of your spending. We do spend category planning. We source money-saving solutions for your spend categories. We implement those solutions, and we review and perform supplier compliance audits. The problem Strategic Source solves and helps you correct our high expenses and broad category bases. Another tool is our strategic spend analysis. This is more of a strategic broad look at your expenses. We analyze them, we put them in the correct category buckets, and we build a plan for you to execute. Your benefits are you get an organized, prioritized plan and a good staffing plan tool. With all these ideas, we can help direct you to a 25% savings. Contract tracker. Most dealers have a number of contracts. Actually, many contracts, and maybe many more than you think about. Keeping current and managing all the terms of those contracts can be quite a daunting task. SSI Contract Tracker gives you contract visibility, advance alerts on expiration dates, and risk mitigation because you may need time to renegotiate points on that contract, and Contract Tracker will give you that edge. SSI Spend Management Suite solves the problems of poor staff training, no contract management, high prices, and weak profits. SSI Spend Management Suite provides strategic focus, contract tracking, improved pricing, and profits. Expense Edge was created by our database of thousands of price comps that we continue to collect every day. This is kind of similar to Home Depot. We provide the tools and solutions for you to do the work. We give you the data points to keep your costs down. Spend management learning. We do a lot of training in the areas of spend management. We've trained many folks and we do many webinars a year on purchasing 101, 102, and 103. Simply put, we can teach your team how to do what our team does, and it saves you money. Hopefully, this has been a helpful presentation today. And again, scan our QR code and we'll get information out to you right away. Thanks again to Scott and Brian from Driveline Automotive for their presentation. As a note, Strategic Source does not take any type of compensation from our suppliers, but we do know that we have vetted them. We know what their work product is, and we know how productive and competitive they can be. We would encourage you to take a deeper look at our suppliers' offerings. Thanks again for attending today. Back to you, David.
All right. Thank you, Chuck. We are ready for a post-session survey to be brought up. We'd love to get your feedback on the time. Let's bring this up. It's just a short 2-question thing. You spent an hour with us. We'd love to know what you thought. So thank you, everyone, for your time today. And we look forward to you joining us on future Profit Improvement Webinar Series events with Strategic Source. Have a great rest of the week, everyone.